welcome. You're listening to The Best of Investing on Talk 910, the show where we present valuable information about real estate, the financial markets, and other economic business of the day. I'm your host, Edward Brown, and I'm proud to have as my co-host Mark Hanf of Pacific Private Money, California's fastest growing mortgage investment firm. Our phone number is 888-912-1190. Use that number to answer the trivia questions for 3 vacations given away during each commercial break. That's right, we're giving away 9 vacations during this show. Now, the vacations are not sponsored by the radio station, but by Lighthouse Resort and Marina, which is located 1 hour northeast of San Francisco. And the vacations are free. Their only request is a $75 cleaning fee to cover housekeeping expenses. Check them out, Lighthouse Resort and Marina. You can reach them at 916-777-5511. Now, today's trivia theme is odd trivia. They're just some of these random trivia ones, okay?
Great.
All right, our website is bestofinvesting.com. Check us out on Facebook and YouTube by typing Best of Investing Radio Show. Also, check us out on television, Comcast Channel 26 and AT&T Channel 99, Saturdays at noon, Sundays at 6 p.m. Mark, we're going to get right into this. What's going on with real estate?
Well, that's the big question of the spring of 2014 is what is going on in real estate? And so as a private money loan broker, I'm talking every day to people who are, in the business of real estate, both borrowers and those who are lending their money out. And we'll talk a little bit more about that later. And I can't. It's interesting how many of these clients are asking me. So what do you think is happening in the market right now? Do you see it getting softer? Do you see
Another bubble?
Yeah, right. Are we in another bubble? Is it going to go down? Is this inflated? Is it real? And what's interesting is we've had a lot of guests on recently, and some of them realtors, and I find it fascinating that most of the realtors, bless their hearts, they're really bullish. The market is hot. It's never been a better time to buy or sell, depending on whether a listing broker or and it's not that they're wrong, because they're not wrong. Because what we're finding here is it really depends where you live. California is a funny state, and of course we're here in Northern California, and I am familiar with Northern California micro markets more than I am Southern California, so I can't really speak for Southern California very much. But here in Northern California, gosh, the Bay Area, we have so many markets and so many micro markets. So, for example, Marin County, very high-end homes, and those above, say, 2 million, very, very interesting market right now, moving very well. Okay. San Francisco, as you know, we've got a tech bubble going on there, so there's a lot of money floating around there. It's hard to find a place to rent. It's hard to find a place to buy, and we had Patty on last week, Patty Cohn, who's a specialist in high-end homes in San Francisco, and she was saying in San Francisco is one of those unique markets where people will price lower than they think it's worth the house on the market, and then create this frenzy where people are overbidding, and that's really that doesn't happen in most markets in the Bay Area. It's almost unique to markets like San Francisco and maybe the Silicon Valley. Silicon Valley then again too, because of Google, Apple, Facebook, all of those companies that are thriving. There's a shortage of houses. It's pushing housing prices up. People are making all cash offers. So the market's hot there. So basically the coastal counties, Marin, San Francisco, you head south into Silicon Valley, all doing very, very well, and hard to find a place to rent, hard to find a place to buy, and really no end in sight right now in terms of how much higher could it continue to go. Now that many of the prices have reached or surpassed pre-recession levels. Very interesting. Now let's go across the bay. Let's go to Solano County, Vallejo, Oakland, Alameda County, as you're heading down towards San Jose. Much different story. Sales are, and this is all anecdotal information that I'm hearing from people, as we make a lot of loans to people buying, fixing, and flipping across the bay in counties like Alameda and Solano, East Contra Costa County, where there are still a lot of distressed homes and a lot of opportunities for you to buy a home that you could remodel and then resell at a profit. Well, I'm seeing some of my clients who are saying the days on market, which is, or DOM, days on market, which is how many days a property is on the market from when they first list it for sale and they actually close. That has Well, over the last 12 months, that was a fairly small number in some neighborhoods, under 30 days, which is usually pretty good. Anything between 15 and 30 days is usually considered a hot market. When
Sure.
we're seeing days on market start to creep up a little bit, and people who have priced based on an expectation of an appreciating market are now seeing that they have to back down a little bit on some of those prices. But even that statement is a generalization because there are neighborhoods in Oakland, for example, that are still very hot. And when a house goes on the market in that neighborhood, I'm going to throw out the name Maxwell Park as an example of a neighborhood that for the last several years has been one for someone looking for a home in Oakland. When one in Maxwell Park tends to come on the market, that one is one that tends to get a lot of offers if it's well remodeled, assuming that's well remodeled.
What are the prices in that area?
Oh gosh,
What do they range?
resale, you're seeing anywhere from 350, 400 on the low end to mid fives, 600,000. So it really depends on the size of the house, of course. But so you can still make money in real estate. Prices are still holding steady or going up. But in the background of that, and this is the chatter in the media that is causing people to call me up and ask me, well, Mark, what do you think? Is like, for example, I mentioned this on a show a couple weeks ago that First Tuesday, for example, is an educational company, real estate education company that has a lot of blog posters, and they their bloggers have been predicting a softening of the market in California statewide. And again, so it's really hard to say what does that mean for Alameda County or the Bay Area or San Francisco. We don't know because of the micro market effect. But they have predicted that over the next 12 months, we should expect a softening of the market and a dip in prices anywhere from 10 to 15%, which
That's pretty significant.
that's a pretty significant prediction. I'm not sure I believe that's going to happen. And of course, nobody's crystal ball is really clear in this regard because there's so many variables that affect housing prices, including jobs, income, inventory, and forces outside the price of oil, unstable national markets. So I don't have a prediction as to where real estate is going. Again, for reasons that we just covered, there's too many micro markets. Ask me what I have opinions on what I think might happen in Marin or San Francisco or Silicon Valley or Oakland, but California as a whole, too large a market to really make a prediction that's meaningful. And national statistics, forget about it. It's meaningless to someone here in the Bay Area wondering whether or not they should buy a house to remodel and flip. If you're looking at national news statistics,
yeah, I mean, it's like saying, how much is a painting worth? Well, John Picasso compared to Pablo Picasso, there's probably a little bit of difference. Okay.
My dad used to say that you can always make money in real estate, and I read somewhere else another quote from someone. It's always a good time to invest in real estate, and that's true. It just depends on how well you buy.
Yeah.
A lot of real estate investors say you make your profit when you buy the property, which means if you pay market price for it, and we're looking at potentially a softening market, you might find yourself doing a whole lot of work and not making a profit on that sale. But if you buy correctly, you buy off the market, you buy a short sale, you're savvy in your marketing and in your negotiations, you can still buy properties and remodel them nicely, put them on the market, sell it to a family who can still get great financing in this market and make a nice tidy profit for yourself.
All right, we're going to cut to our first commercial break. Again, the theme is odd trivia. All right, coin wrappers, right? What are the 4 colors normally used for pennies, nickels, dimes, and quarters? You got to give us all 4 of them, all right? The first 3 callers with the correct answer win a free 3-day 2-night stay at the Lighthouse Resort. Call 888-912-1190. That's 888-912-1190 to answer this question. Coin wrappers. What are the 4 colors normally used for pennies, nickels, dimes, and quarters? Don't touch that dial. The best of investing will be right back. Mark Pomp is going to get into some emails. One of them is extremely interesting. Stay with us.
I'm coming back.
That's it.
Nice.
You guys ever call the fair one?
Yes, we're going this weekend.
Oh, you got all set. Good
yeah,
for you.
we're going this
Good for
weekend.
you.
In fact, I finally today I've been trying to remember every day since Sunday to call them and book our treatments.
Dude, those photo treatments there.
Oh, yeah, so we got the media rate, which was half off, which was about what we paid 10 years ago the last time we went, because it's like $750 a night now. It's just amazing. I know.
And lots of it.
Yeah, absolutely.
In fact, I'm calling her right now. Take care of my boy.
My recommendation to you is
I figured I'd be careful because we're videoing here. Okay.
indeed. Going to email?
Yeah. Let me get into this right here. Okay.
Oh yeah.
Well, welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Holmes, president of Pacific Private Money, California's fastest growing private investment firm, mortgage investment firm. When we got to the first commercial break, we asked this trivia question. Again, the theme is, just kind of odd trivia here. Random one, I guess, is better. Coin wrappers. What are the 4 colors normally used for pennies, nickels, dimes, and quarters? You remember that?
I do. I know what you're talking about because I haven't rolled coins in a while.
Yeah.
It's like pennies were the pennies red?
Red.
Dimes.
Okay,
Oh,
the pennies are red.
Nickels green.
No, blue.
Blue. Okay.
Dimes.
Dimes green.
Green. Quarters.
Chartreuse.
Orange.
Orange.
Orange. pretty close.
Okay.
Okay, really quickly, before we get into email time, let me just, we're doing a little promotion here for the Hornblower.
Oh yeah.
So Father's Day will be here before you know it. This year, give Dad the kind of gift you can't buy in a store. This is amazing. They have give Dad a beer brunch cruise or a 4-course dinner cruise from Hornblower Cruises and Events. It's a memory that'll last a lifetime. A lot better than giving them a tie, right?
Memories are better than things.
They sure are, especially with the Hornblower. Visit hornblower.com or call them at 855-538-7558. I love going on that Hornblower.
Indeed.
Okay, and so anyway, here's the special trivia question where we're giving a couple of Hornblower tickets away. So let me read the rules first. Okay, the rules. If you've ever won any kind of prize on the Best of Investing, unfortunately you're not eligible. So new listeners only. And you have to email Edward at bestofinvesting.com tonight by midnight. And then next week we'll read from among the correct answers, randomly choose the winner. Okay? Here's the question. Although we have a lot of these, we use less than 10%. What? Okay, that's the question. All right, now we're
I
gonna.
think I might know that.
You might not know that one. Okay.
Am I eligible?
Yeah, of course not. Okay, here we go. We are going to go to email time here. All right, so we teased the audience a little bit with this interesting email, or we told them we were going to come up with this. How does it make sense for you to do such an anticipated short-term loan, such as the one you mentioned last week, about the credit score being 1.2 low for an FHA loan? Okay, so basically what he wants to know is, how does it make sense for you to do short-term loans?
Oh, and the answer is very, very simple. So at Pacific Private Money, we specialize in making fast, quick, easy loans to people in need of fast, quick, and easy financing. Traditionally, when we started the company back in 2008, we started it as a result of the fact that banks stopped making loans to real estate investors. And in fact, the private money loan industry, which is also called the hard money loan industry, really was the go-to resource for contractors and real estate investors who spent the last 5 years buying foreclosure properties, remodeling them nicely, and putting them back on the market. So a really important part of the economy was really non-bank financing and private capital that was being put to use. And the lenders, the people who are participating, using their money and allowing it to finance and remodel property, they're making great returns. And we've been providing our investors returns of 8% or more consistently over the last 5 and 6 years, and our borrowers have had access to fast capital. We typically close in 3 to 5 days, although we prefer 5 to 7 or 10 days, but we're fast when we need to be. But more recently, with the passage of the Dodd-Frank banking reforms, the unintended consequence of the tightening of the leash on banks is that a lot of bank loan applications fall apart midstream.
Love those guys.
So you go out, so you're a home buyer, you go out and you make an offer, and you put a deposit down, and it's subject to financing, but the banks tell you, okay, well, you're pre-approved, and so typically after 10 days, your deposit goes non-refundable, and which is typically how a transaction works. Well, we get calls every day, it seems, from people who are in contract to buy a home. They've gone beyond the period for when they could cancel and get their deposit back because they've done the inspections, everything looked good. They thought that their bank loan was all lined up, but something glitches, something happens. It's not unusual, for example, if you're in say a 30 or 45-day escrow, your credit might have been pulled prior to you even making the offer on that property by your mortgage broker. And he saw that you had a 682 credit score, and he said, you're good. Anything over 680, that works. Well, you get into contract, and time's going on. Banks like to pull fresh credit reports, typically within a certain period before you're about to close.
Sure,
if you've gone over a certain
something could have happened in between.
I don't know what it is, different for all banks, but let's just say it's maybe 30 or 45 days have passed, and the bank wants to just re-pull your credit. Well, that's when the fun sometimes happens. Actually, I'm being facetious. It's not fun at all to discover that something happened that maybe you weren't even aware of, and now your credit score is dipped below that number that the bank is basically the floor. And the bank, we beat up banks a lot here, and they're thanks to the bank, we have a thriving business at Pacific Private Money.
It's the regulators.
But but if their banking regulations are such that they can't make a loan to you below 680, they can't make a loan to you below 680. And so and the story we told yesterday, I think was actually it was 620.
Yeah.
It was a little bit less. He was 622 or just
622, and then they were trying to get FHA financing because it was the lowest rate.
Yeah.
And they pulled, I guess, by pulling the credit one more time, that was considered a hard pull. Yeah. The credit score dipped to 619, and the FHA says that's not 620.
So this kind of stuff happens, and that's when I get a call, usually from a mortgage loan originator that I know, and I know a lot of them, and in fact I market to them to let them know that this loan product exists if they have a client in trouble. And so we talked about several examples over the last several weeks of stories that quite frankly are just they're almost shocking in terms of the pain that people go through. It's hard enough to buy a house than to be whipsawed back and forth by by the banks. So the question that the emailer asked was, how is it profitable for you as a lender to make a short-term loan? Well, it's profitable because there's two ways we charge a borrower. One is there's an interest rate on the note, which tends to be right around 10%, so it's not low. But if they pay us back within, let's say they pay us back in 4 or 6 weeks, and sometimes they do, not often, but it's more typically a short-term turnaround payment might be more like 60 days or 90 days. Still not a lot of interest is being earned by the lender, but we also charge something called origination fees, also known as points. And the point is 1% of the loan amount. So on a $500,000 loan, we will typically charge 2, maybe even 3 points. So that could be anywhere from $10,000 to $15,000. Now that seems like a lot of money, and you might even think that's predatory, and it's one of the reasons why they passed all those laws to keep you guys, to keep you guys honest. Well, you know, look at what you're getting. It's a cost of do you want to get the property? Do you not? And so the way our business model works is that our company, me the broker, my company, our compensation is really from the points, not the interest. The interest goes to my private capital investors. So there's a brokerage relationship. I'm in the middle between the borrower and the private capital lender. I have the stable of lenders in my database that number in the hundreds.
But with a fund, I mean, you also have a fund.
We also have a fund too. We've got a fund and we have individual investors, and both of them will have capital at any given time that's available to loan out. We process applications on a weekly basis, and our investors or me as the fund manager, we pick and choose those that we want to go into. So again, we can make money from a short-term loan because those points are non-refundable. So when and they're paid from the loan proceeds. So when a borrower, let's say he needs $1 million to close on a $1.5 million acquisition, which is a fairly common transaction that we do, and in that case, we would probably charge maybe 2 points because we tend to lower the points a little bit as the loans get bigger. So 2 points and 10% for a short-term loan would be fairly common. So we collect $20,000, and if you just pay it back in a couple of months, well, that's fine because we're going to turn around and lend it out again and charge another 2 points. So we make money through the revolution of capital through origination fees.
Yeah, so you guys would actually love to pay it back in a couple of weeks, then lend it out again.
Right. So it's not that we're loan sharks; it's how the business model works. It's brokers like myself, like our group of folks at Pacific Private Money. We're paid. The overhead, the commissions, the people that work, our underwriters, our document drawers, and processors. They're all paid from those fees that we generate. Meanwhile, we're providing a service that would normally not be there because the bank's not going to make you a short-term loan. No. And if the bank already canceled your transaction, you're SOL, right? Unless you can find somebody to pay.
I got a question for you before we go to our break here. Do you ever have a situation where you charge, let's say, 3.5 points, but if they pay it back within 6 months, you'll refund some of the points?
We've done that. That's creative, and we've done that for certain lenders. It's more common, and we do charge anywhere from 2 to 4 points. It depends on the complexity of the loan, how fast they need it, because we have to drop everything and try to get your deal done by Friday. I think we're entitled to a slightly higher fee. And the area where it is certain parts of Northern California, we might charge a little more just because we don't have as many investors, or we may not be particularly interested in that area. But if the deal still makes sense, we can still fund it. So there's a number of variables there.
Okay. And when we come back, I'm going to ask you for the latest deal of the week. We're going to give our audience something interesting to listen to on the most recent deals.
Yes.
Okay. Here's the second trivia question. Again, the theme is just kind of odd trivia, random. What is the only continent without reptiles or snakes? The first 3 callers with the correct answer on a free 3-day 2-night stay at the Lighthouse Resort. Call 888-912-1190. That's 888-912-1190 to answer this question. What is the only continent without reptiles or snakes? Actually, a snake is a reptile, isn't it? Okay. Well, we'll just leave it at that. All right. Don't touch that dial. This Best of Investing. We'll be right back.
Ulster.
Working on something. Always working on something. Just get tired and worked out.
You got the ons?
Yeah. Yes. It's not you, don't take it personally. For our A shareholders, do they have to just, what, the suitability requirements on that, or like, no.
Not really.
I like that.
Yeah. I mean, there is an investor questionnaire we should probably have them fill out, and technically we shouldn't. They shouldn't be we have people that do it all the time. It's like they want to.
Sure. Okay. All right, ready?
Yes.
Welcome back to the Best of Investing. Again, I'm Edward Brown, your host, along with Mark Hahn, president of Pacific Private Money, California's fastest growing private mortgage investment firm. When we cut to the second commercial break, we ask this trivia question: what is the only continent without reptiles or snakes? Answer.
New Zealand. No.
That's not a continent.
Oh. Antarctica.
Yes. Antarctica. Very good. Antarctica. Okay. So, Mark, give us the latest deal of the week. What are you working on?
Well, it's more consumer-related loans recently than a year ago, and
Give us the definition, because I'm not sure if people understand consumer versus.
so when I started Pacific Private Money in 2008, it was largely to serve the investment community, and those are also referred to as business purpose loans. In other words, I was making loans to people who were in the business of buying, fixing, and flipping real estate. And that was probably 75% of our loans a year ago, and certainly 2 and 3 years ago. Now, that's lightened a little bit due to a couple of factors. Number one, there are a few other companies that have opened up their shops here in the Bay Area that have built, their mousetrap, and they're now competitors. And so we're seeing fewer, at least in our company, we're seeing fewer as a percentage of our total deals, fix and flip loans. And it's also the market's quieting down a little bit. There aren't quite as many opportunities. There's not this flurry of flipping going on that there was in 2011 and 2012 and through most of 2013. In 2014, we've seen a significant slowdown in the finding, fixing, and flipping market. So the consumer side is really anything where the purpose of the refinance is consumer in nature versus business. And so here's an example. I got a call this past week from a guy who he owns his home, has got a small mortgage on it. Then he owns 2 other homes that are free and clear. They're all virtually within a few blocks of each other. And one of his investment homes is rented out to his mom, and the other one's rented out to his daughter. So that actually, I don't think he charges his mom, but I think he told me the daughter pays rent, but the money actually goes to take care of mom. So nice arrangement, and that's probably not that unusual. He doesn't have good credit, and it's not really relevant to get into the reasons why, but a lot of people just don't have good credit. Stuff has happened in their lives, so he's not bank financeable. The banks aren't going to, even though he's got tons of equity, he's got 2 homes in San Rafael that are free and clear that are worth between $600,000 and $700,000 each, and really he's just looking for $150,000. That's all he wants.
But even if his credit was good, he might still not be able to because the rental income doesn't support it.
Right, and it's rented to family.
Yeah.
Which is so even if he did have good credit, the banks would look very, very tough on is this arm's length? What's happening with the rent? Can I see some bank statements? What are you going to do with the money?
Well, that's the question.
Right.
What is he going to do?
Well, he's self-employed, and he does have a pension, but his self-employment income, as he said, has gone up and down. So but he wants to borrow the money. And here's the interesting thing: he wants to do some improvements on one of the 2 properties. He wants to change out the roof. The other reason is he just wants some liquidity. He's been, he hasn't had that many jobs lately, and he just wants to have some money sitting around so he doesn't have to stress out about making his next home loan payment. And there's nothing wrong with that. We've made loans over the years to people who who for no other reason that they wanted to take equity, convert it into cash, have it sit in a bank account so it would look good to a bank so they can get the type of financing they really want.
Oh, I see.
Low rate financing. So that's a strategy that you can use as a consumer. But again, there's not a lot of companies out there making consumer-related loans. There's not even a lot of private lenders. So at Pacific Private Money, we really started this year in 2014 to really dial in our understanding of the new Dodd-Frank regulations with respect to consumer loans. And this even impacts consumer loans on a rental property. So in other words, if you've got a rental property, technically that's an investment, but if you pull money out of it for a consumer purpose, that's still considered a consumer loan. I know that may not sound like it makes a lot of sense, and your eyes might glaze over trying to figure out what the heck that means, but we have to, unfortunately, as lenders, we have to be mindful of that, because if we make a loan basically the way the regulations work in a nutshell today, if we make a loan to a person that they clearly can't afford to make the monthly payments on,
Yeah.
that's basically the definition in layman terms of predatory lending. And there's a lot of anti-predatory lending laws.
Well, what are the consequences?
Well, the consequences are that all of the payments they make on that loan go to pay down the principal. It becomes an interest-free loan.
Wow.
So it doesn't become free money.
Yeah.
But if it's egregious, the broker could be fined. But it's really that what's happened is there's a lot of private money brokers out there now that really have just said, look, I'm only going to do business purpose loans. I will no longer make consumer loans because why would I want to be taken to court in 2 or 3 years by some attorney who's going to accuse me of being a predatory lender when all I did was get the kind of loan he asked for?
Yeah, exactly. So in this example of what you're doing, the value of all the properties is what, $650, you said?
Yeah, I mean, the 2 properties are about $700 each. I mean, I don't even need to look at it. Basically, I can make him a loan on either one of those properties, $150,000 on either property. It probably makes sense to do the one that he's going to make the improvements on.
Sure.
Right?
So do like 20% loan to value?
Yeah, it's going to be about 20% loan to value. So you would think that would be a no-brainer loan. And in fact, 10 years ago, that was, music to any hard money lender's ears. But nowadays, because of consumer protection laws, it's a lot harder to find someone to do those loans.
But you will do that.
Oh, absolutely.
Okay.
Yeah,
What are you charging?
That one, probably about 9%, and because it's a smaller loan, I'm going to charge 3 points rather than 2, because we usually try to solve for a minimum fee to the company.
And is that going to go in the fund?
That one very well may.
That's a nice loan for the fund.
Oh yeah, absolutely.
In fact, we have some time. Get into exactly the fund, because you also said you had some private lenders, but you also have a fund.
Well, I do have private lenders. I work with a small core group of private lenders that have been doing private lending for, some of them for decades, and we actually have more private lenders than we need right now. And when I'm talking about private lenders who specifically want to invest in an individual note. There's 2 ways to participate in what I'm going to call mortgage investing, and that is also known as the alternative investment strategy of lending your money out for returns of 8%, sometimes 9 or even 10% or more, depending on where you're lending. In certain markets and in certain states, private lenders are getting 14, 16, 18%. Just in California, you don't typically see rates like that, but certainly not in the Bay Area. We have some of the least expensive hard money in the Bay Area, and usually that's around 10% on the note rate, that is, and investors can expect to get anywhere from 1 to 2 percentage points less than the note rate. That's fairly customary in the business model of brokering private money loans. But the Pacific Private Money Fund we started exactly a year ago because of the fact that I had too many people calling me up wanting to participate. Who doesn't need higher returns, right? I mean, everybody needs to find ways to diversify their investment portfolio so that they have some higher yielding assets in there that will boost their earnings.
But not undue risk.
Right, but without unnecessary and undue risk. That's exactly right. We have 2 types of investors: those that are in it for the growth and those that are in it for the income. And in our fund, what's great about the fund is you can do either or. It's hard to do that in an individual note. In an individual note, you really got to get paid every month, and so it's really an income as opposed to a growth strategy. Although, if you're getting 8, 9, 10% on an individual note, and you're just letting the money build up and then lending it out, of course, that's a growth strategy. But in our fund, we make monthly distributions of the interest to shareholders, or if you're a growth investor, you can let it buy additional shares every month, the dividends, that is, and it can compound. So, for example, in the last year, our fund on a simple interest basis for those who are taking distributions, we've paid to date 8.24, so 8.25% has been the return to our fund investors who've been taking the income, and the return to the growth investors has been 8.53, so that's on a compounded basis, 8.5%. And for that, they didn't have to do anything except write a check and go on their merry way and live their lives and let us do the work of investing and reinvesting their capital.
It's sort of like when you buy a mutual fund, you write the check and then you just watch the market or whatever. In this case, the principal stays the same. So this is very intriguing. I'm sure the audience wants to know, how do they get a hold of you if they want to invest?
Well, if you haven't heard of mortgage investing or private lending or trustee investing or mortgage pool investing, those are all terms used to describe different facets of how you can make 8% or more, all secured by real estate. You really should give us a call or email us. I'll give you our phone number. You can call, leave a message, and we don't do a hard sell. We'll just send you information via email. You can read it. You can get back with us by phone. You can set up an appointment to come in and meet with us in our downtown Nevada offices. But our phone number is 415-883-2150. Again, 415-883-2150. Or go to our fund website, and the address for that is pacificmoneyfund.com. Again, the fund's website address is pacificmoneyfund.com. There's a place on there you can put your email address and your name, and you'll automatically receive some PDF information via return email about the Pacific Private Money Fund.
And stay with us, Mark, because when we come back, I want to get into the risks, because people hear 8-9%, whatever. It sounds risky.
Sounds too good to be true. That's a good topic.
Okay, we'll talk about that. Okay. Third trivia question. Again, we're talking about random trivia here. This slave's name was originally Frederick Bailey. He didn't like his last name because it was a slave name, so he changed it to what? The first three callers with the correct answer on a free 3-day, 2-night stay at the Lighthouse Resort. Check out them at 916-777-5511, or just Google Lighthouse Resort and Marina. Call 888-912-1190. That's 888-912-1190 to answer this question. This slave's name was originally Frederick Bailey, but he didn't like his last name because it was a slave name, so he changed it to what? Don't touch that dial. The Best of Investing will be right back. Mark's going to explain how risky or not risky this fund is. Oh, it's super risky.
You'd be a fool.
Yeah.
I didn't say that.
Yeah. Sorry, fun tape. That's whatever a spider can. I used to love that.
Yeah. Spidey. I was flipping channels the other day. I was watching one of the Spider-Man movies. There's like so many of them. It's like there were the first 3 reboots and the second 2 reboots. I think the second's in theaters still.
Okay. Let me see how much time we have.
How much?
7:41.
Just throw something at me if I go long.
Okay. Yeah. Here you go. Welcome back to the Best of Investing. I'm Edward Brown, your host, along with Mark Hahn. When we asked the third trivia question here, this slave's name was originally Frederick Bailey, but he didn't like his last name because it was a slave name, so he changed it to what?
Frederick Douglass?
Yes. I was going to ask the other way around. Frederick Douglass, what was his original name? But I'm probably the only guy. I'm probably the only guy who knows that Frederick Bailey. He read a book about him years ago. Okay, so Mark, when we cut to the last break here, we said we were going to discuss how risky or not risky the fund is.
So, I mean, that's really one of the biggest decisions someone has to make when they're looking at high-yielding investment opportunities. That includes investing in real estate, or lending your money out privately to someone, or investing in something like a REIT. I mean, there's all kinds of stuff. Gold, or gas and oil futures. I mean, there's just
anything.
Pork bellies. It's. I mean, people are in the stock market all the time. How risky is the stock market? right now. It goes up, it goes down. Can you lose principal in the stock market? Well,
Yes, you
of
can.
course you can. Can you lose principal in a real estate investment? Yes, you can. I personally have. You did too, Edward, in the last
Unfortunately.
downturn. The Pacific Private Money Fund. Let's talk about that a little bit. There are mortgage pool funds that exist all throughout California. In fact, all throughout the United States. They're basically also known as private placements. They are somewhat regulated, but there isn't a tremendous amount of oversight on a mortgage pool fund. So really, it comes down to who is the manager. And so the reason I felt it was time for us to start our own mortgage pool fund last year in 2013 was because by that time we had done over 600 million loans. 600 loans totaling over 150 million at that time. We've gone well beyond that today, and people were knocking at my door, pounding
Sure.
on the door, saying, can you please send me the next opportunity? And I like most of my investors, and you want to please them, and they'd call me. I haven't heard from you in weeks. What's going on? So, so really the answer for me as a broker, as the business model for for a business like mine is, well, why don't we put together a mortgage pool fund, and then anyone who wants to invest, when they have money, they can invest it when they're ready to write the
Yep.
check, and then we activate that money fairly quickly by lending it out, so it begins to earn money right away. And then they don't have to worry about things like early payoffs. They don't have to go drive the property. There really isn't anything to do. So other than write the check to the fund in return for membership interest. So the risks in a fund, the risk is really diversified over the assets in the fund. So that's what's nice about a fund compared to an individual note investment. When you lend to an individual secured by a property, sure, you can drive the property and you know where it is and you feel comfortable with the location and the loan to value and maybe even the borrower because you can look at the information. But still, it's secured by that one property, and stuff happens. And what if that person can't pay you back when he said he was? What if he stops making payments? So there are things you need to do, and that's the risk on an individual note. On a mortgage pool fund, you don't have that kind of risk because again, the fund manager is really the one who is taking care of all of that, and your risk is spread over all of the loans in the fund. In our case, we've got 22 loans in the fund right now. It's nearly $5 million in size, and we intend to grow it to we wrote the private placement anticipating that we might grow it as high as $50 million. But at $25 to $30 million, that'll be a size where it'll probably service a lot of the deals that we do. And so the risk really, when you think about it compared to stocks, here we're paying 8% because we're earning nearly 10% on that fund, and we're paying 8 to 8.5 to our investors. And the loan to value, the combined loan to value of all the loans we've made divided by the value of the real estate we've made loans on is 62% right now.
Well,
It's
that's
hovered
pretty low.
between 60 and 64. That's the highest it went was 64, and right now it's 62. That's a pretty conservative valuation right there. So how risky is 62% loan to value when the banks are every day making loans at 80%. So
Not much.
and last but not least, it would be disingenuous for me not to say, well, Mark, what if you decide to run off to Mexico? And so that is something that I deal with. A question I deal with. I've even dealt with that with people who know me. It's like and I wasn't sure they were saying it in jest. But the bottom line is that we're not we're a small company, but we're not an insignificant company. We have 5 employees. We've got 4 loan agents. We've been located in downtown Novato for 5 years now. I've been a Marin County resident and investor in real estate myself my entire life, and have been in business since 1982 in real estate, working for a family-owned company before I started Pacific Private Money in 2008. So I've got references a mile long. I've got a family here. My daughters are grown up here. They're involved in sporting activities locally. I'm not going anywhere. I need this job. This is a lot of my assets were hammered in the Great Recession, and and I need to work for the next 10 or 15 years to make sure that I can retire comfortably, and I'm helping my clients retire more comfortably by providing them with 8% returns that they can count on a monthly basis. So for more information on how you too can participate, again, give us a call, leave a message, and we'll return the call next week. Our phone number is 415-883-2150. That's 415-883-2150, or visit our website at pacificmoneyfund.com.
Thank you so much, Mark. Okay, we're going to cut to our thoughts for the day. Get this. In 1963, baseball pitcher Gaylord Perry remarked, "They'll put a man on the moon before I hit a home run." On July 20th, 1969, a few hours after Neil Armstrong set foot on the moon, Gaylord Perry hit his first and only home run. Isn't that amazing?
And I have never heard that story.
Isn't that great? And dueling in Paraguay is legal as long as both parties are blood donors. Now that makes sense to me.
Okay.
All right, tune in next week to The Best of Investing. We're going to be giving away 9 more free vacations for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown. We're wishing you the best of investing. So long.
That's great.
Isn't that wild?